Hello and welcome to On Point, a podcast series of fresh thinking on the big topics for corporates and institutions. I'm Neil Parker, FX Markets Strategist at NatWest. In this episode of On Point, we're going to dive into the big questions and themes shaping the economic and funding outlook for UK and European businesses in the second quarter and the year ahead. Will the post-pandemic economic revival lead to a lasting change in the structure of economies and certain sectors? As economies reopen, will a quick rise in consumer spending lead to higher inflation, higher bond yields, and as a result, higher borrowing costs? How are investors' preferences changing amidst a broader market shift towards resilience and sustainability? And most importantly, how could all of this affect the average corporate in the UK and Europe? To help shed light on this, I'm joined by Ross Walker, co-head of Global Economics and Chief UK Economist at NatWest Markets, and Sam Boughton, Director, Corporate Syndicate at NatWest Markets. Good afternoon. And so the first question I'm going to ask is to Ross. So Ross, the current macro theme is around the reopening of the UK economy, which happened this Monday. When is it likely that we're going to see the turning point for not just the UK, but also European economies? And what shape do you think the recoveries are likely to take?
Thanks, Neil. Well, in terms of when we actually see economic growth resuming, it could be earlier than you might think. We'll get UK GDP data for February, which I think could show some modest growth, broad stagnation, but modest growth. And then much of the survey data is signaling, even as soon as March, quite a marked acceleration in growth. And again, that might seem a little bit surprising because the actual easing of restrictions in February and March, formal restrictions, were quite limited. But there is evidence that the economy is becoming more adept at functioning in that restrictive environment. And clearly, we also believe, and this is a bigger theme really for the remainder of this year, that as we get a broader reopening, particularly consumer leisure services, that's when we're going to see growth really accelerate quite strongly. So through the summer and autumn months, quite possibly into 2022, though some of the underlying fundamentals suggest that you would then, by that point, by, say, spring next year, growth rates, consumer spending, and so on, would be beginning to gravitate back to more normal rates. But as I say, it looks like some recovery at a relatively early stage, and we will see a really marked acceleration in growth through spring and summer.
And just for the listening audience, could you put some numbers about what you think the UK will grow by in 2021 and 2022?
So for this year, we're looking for economic growth of just over 5%, 5.3%. So if you think that's more than twice and even on some estimates, maybe closer to 3 times what the UK might normally be expected to grow by. And then even faster growth in 2022. Some of that is to do with the base effects and the timing of the uplift in the recovery. But in essence, we think the strength we will see being consumer-led in 2021 will have some favorable spillover effects to the corporate sector and investment, some recovery in export performance in 2022. So a couple of years which, on any historic growth comparison will look exceptionally strong. Of course, we are starting still from a suppressed and artificially suppressed base. And so, there is still some catch up. But nevertheless, I think by the early part of next year, you would expect UK economic output to be broadly back to pre-pandemic levels.
Excellent. And people can't see me, obviously, but obviously hairdressing is not something that's going to be top on my list of priorities. But what sectors do you think are likely to outperform or even underperform in the recovery?
Well, the outperformance, we think, will be very much skewed towards consumer services. So hairdressers, obviously in my case, they don't get a lot of money out of us these days. But the bars still do. They still might. Restaurants, theatres, and also just as we see so-called non-essential retail reopening, I think there will be a tendency not to stay at home and keep purchasing everything online, but to get back into city centres for the experience. So I think retail as well. There's some discussion that, well, if we're spending much more money and on meals and theatre tickets, we'll or other areas of retail stuff. But I'm not so sure. I think actually we're going to see a period of fairly buoyant and fairly broad-based consumer demand. Some other sectors, say transportation, travel, tourism, they might take a little bit longer to get going, and will obviously depend on the easing of restrictions elsewhere in the world and what restrictions the UK government continues to place on some of those activities.
Excellent. Thank you for that, Ross. And turning to you, Sam. So before the end of 2020 and throughout much of 2021 so far, the dominant theme in credit markets has been the rise in yields. What has been seen in terms of corporate issuance and duration over Q1, and what does the outlook look like for the remainder of this year?
Sure, thanks, Neil. Yeah, I mean, I think what we've seen during Q1 is a significant rates volatility, which has led to some nervousness from the investor base. So I think before you saw the significant rates volatility tick into the February and March, the average concession in corporate markets in the first half, in the first part of January, was actually negative. Whereas if you look at the average concessions where we've now moved into the March period, we are in sort of the very low single digits, 4 to 5 basis points. So you have seen from the investor base a pushback just in the overall premium that they're next of the new issue premium they're willing to accept given the rates volatility. And what you have seen is also just a reduction in the amount of long end issuance through the market. I mean, part of that is the fact that when you look at it on a sort of a year-on-year basis, we did see sort of an uptick in issuance through the course of last year, but a lot of corporates have locked in funding through the course of last year, so that has led just to sort of a less need for issuance in the first quarter of the year. But overall, I think what we are seeing is, even if issuers are willing to pay even a marginal concession, then the ability to lock in funding across the curve is there for issuers. What we do think when you look to the second quarter, though, is given the significant amount of pre-funding you saw got done in 2020, is a reduction in the issuance on sort of a year-on-year basis. So when you look at supply of what we're expecting for Q2, we're expecting around 90 billion of supply in the corporate market versus the same period last year of 140 billion. So a significant drop off. We still expect it to be above the average of 2017 to 2019, which was in a context of around 75 billion, but significantly down on a year-on-year basis. However, given the fact we still think it's above 17 to 19, therefore we still expect there to be a reasonable amount of supply for investors to digest. But from a net supply perspective, given the constructive conditions from the central banks in terms of purchases, we're actually expecting negative net supply in the next quarter, which will give further compression from credit spreads. So overall, a pretty constructive backdrop, given you've now got some rate stability. Concessions have normalized somewhat in the market, and going forward, you've got a negative net supply dynamic as you move into the summer. So certainly very constructive conditions for issuers.
Thank you, Sam. Ross, back to you then. We've talked a little bit about the yield curve. Given your thoughts on the economy, when do you see the timing of the first Bank of England monetary policy tightening, and what form will that take?
So I think the first move is still much more likely to be a rise in interest rates and bank rate rather than reversing QE. The Bank of England is conducting an internal study to see what might be the most appropriate form of sequencing in terms of withdrawing the existing policy stimulus. I think the first hike is still some way off, even with the very buoyant GDP economic growth numbers we expect through the remainder of this year. I would be surprised if we actually got a rate rise before 2023. At any rate, I think you would need the strength we see in the coming months to be, to a large degree, sustained through 2022 in order for the Bank of England to raise rates sooner. In other words, I think they will they will give this recovery a bit of time to take root, because as we discussed earlier, this has been a very different recession in terms of the severity of the lockdown, and similarly the speed with which the economy will rebound when allowed to do so. But of course, that means that some of the GDP numbers and consumer spending numbers that we get over the next few months will not really be representative necessarily of the underlying state of the economy. So I think the Bank of England will not be rushing out of the traps to raise interest rates. So we look for the first rise, say mid-2023. How much will they tighten? It's certainly possible that the first move could be a little bit more than the typical quarter point changes that we've become accustomed to, simply because they're raising rates from such an artificially low level, from just 10 basis points. So I could easily see a scenario where the first move is, say, a 40 basis point rise just to take bank rates to 0.5%. The question around this, though, comes back to what do they want to do with that stock of QE that is sitting on their balance sheet? If they tell us when they conclude their review on sequencing, well, we'd like to get that stock of QE down a little bit. In other words, what the bank might do is they might take rates to, say, just 0.5%, maybe a little bit higher, maybe 1%. And at that point, any additional monetary tightening might be done primarily through reversing QE, selling those bonds back into the market. As I say, I think they will move first on rates. We will go at least to 50 basis points, maybe to 100 basis points, then some QE runoff. So in other words, what this tells me is that the first move is probably still some way away. Even when they begin to tighten, this will be quite a gradual process. And compared with previous recovery phases, it's not just bank rate we'll need to think about, but also if reversing QE is doing some of the heavy lifting in terms of monetary tightening, that also suggests that bank rate will rise more slowly, and it will reach an eventual level that would be materially lower than where it might otherwise have been. So even when the Bank of England starts to tighten, a slower, more drawn out monetary tightening process.
Interesting. And to sound back to you, what would that rising interest rate environment and a reversal of asset purchases mean for issuers and institutional buyers? And particularly, I'm thinking here, would it sort of draw out a different response, particularly from issuers, if they were trying to get ahead of when interest rate tightening starts to come in?
Yeah, thanks, Neil. I think there's a couple of things. One in the euro market, I think our base case is there's probably more rate stability going forward. So I think from a euro funder's perspective, you may see increased opportunities towards the longer end of the curve, and we do expect swap spreads to steepen, especially in the long end of the curve there. So I think that will lead to some support in the euro market, where you'll maybe see the return of some 30-year issuance, given you saw that a fair amount during 2020. I think in the sterling space, there are going to continue to be some corporates who are very focused on an all-in coupon. And I think if we do see rates continue to back up in the UK, there may be a twist towards looking towards the shorter end of the curve there to lock in the lower coupons at the front end. However, I still think even if you do get a backup in rates in the UK, the investor base, given the natural steer and tendency of the investor base to support long end sterling credit, you're still going to get very strong demand from the pension funds, from the insurance accounts in the investor base. So as long as there is the issuers who will still have a natural demand to issue in the long end, such as the housing associations and the utilities, we're very comfortable that and confident that the investor base will still be there to support in the even in the case if you do get higher rates. I think from the asset purchase facilities, on the CSPP, we continue to see a very constructive tone from the central bank, coming in for 40% of new issues, and we don't expect the ECB to pull that support away anytime in the near term. I think in the case of sterling, the asset purchase facility has come to a conclusion. That did have a strong impact on the sterling market, but I think given where you are from a supply perspective in that market, flat year on year, and you continue to see very strong demand and inflows from accounts, we don't feel at that stage that even with the absence of that facility, the tone has dampened at all in the sterling credit market. So I think even if they do pull away in the euro market in the future, I think the tone there is also equally very supportive.
And so just to follow up on that, Sam, is there anything that you think could materially increase issuance this year that we've not considered already?
Yeah, I think there's two things. So our broad view at the start of the year on issuance was you're going to see a 10% reduction in euro supply. Currently, we're running 20% behind, although we are coming into a period where you will see lower issuance given blackouts, and especially with the last couple of weeks with the 4-day weeks. In sterling, we did expect an increase of 10% this year. Currently, we're running flat year on year. We're just shy of 10 billion in sterling credit. The couple of things we do think may lead to increased supply both in euros and sterling is an increase in M&A, which you are starting to come through as you have increased confidence from firms coming out of the COVID-19 pandemic and they look at the opportunity to pick up competitors. You are starting to see a growing forward pipeline for M&A. We recently were involved in the global financing for the London Stock Exchange purchase of Refinitiv, and you started to see more acquisitions go through, and they'll be funded in the rest of the year. So I think M&A will be one thing which will increase supply. Secondly, I think GSS issuance, that's already running at 3 times the amount of supply in Q1 2021 versus Q1 2020 in terms of the amount of supply which has gone through. And I think just the growing importance of that, both from the issuer and the investor perspective, will lead to further supply. And in different formats, you've started to see the growing importance of sustainability linked bonds versus traditional use of proceeds bonds. And therefore, I think just that sector will continue to grow and become sort of more sort of as a regular way of funding for many issuers. For example, you've got Total, who had just committed to only issuing sustainability linked bonds going forward as part of their financing. So yes, I think M&A and GSS to be short, Neil.
Yeah, I think a lot of what we're seeing with regard to investor appetite would definitely support you with regard to that. Ross, turning back to the economy for a second, recent projections from the Bank of England and the Office for Budget Responsibility suggest multiple years without unemployment rates returning to pre-COVID levels. What are you predicting regarding the unemployment rate over the next few years? And also, how do you think that might alter the dynamic between cost push inflation and demand pull?
Yes, I think the first observation here is that the rise in unemployment over the past year has been much less severe than was feared in the early stages of this crisis. We had official forecasts, albeit on downside scenarios, but talking about near 10% rates of unemployment, so above the unemployment levels we saw during the financial crisis. In fact, the unemployment rate has risen by just over 1 percentage point during the crisis. So factors like the furlough scheme, the parallel self-employed support scheme have obviously made a huge difference. Those support schemes will continue to run for a number of months yet. So, and in some of the recent data, we've actually seen, again, perhaps counterintuitively, some gains in employment despite a wider economic lockdown. So there are reasons to be cautiously optimistic around the labour market, in the sense that although I don't think we are yet through the worst in terms of unemployment rates, because as the furlough support is withdrawn, as the economy reopens, you will then get some restructuring of businesses and the labour market. and I think there is still a risk that we see unemployment drift a bit higher. But on our forecast, we see a peak of just above 6% around the turn of this year, so after the furlough scheme has closed. It may be that unemployment is then a little bit sticky at these levels. It doesn't necessarily fall back dramatically. A lot of that will obviously depend on underlying growth and the outlook for the economy. But nevertheless, if the peak in unemployment is around 6%, then, all things considered, that would be a huge relief in terms of the general state of the economy. As you say, there are some big structural adjustments coming. Of course, we have the Brexit process. It remains to be seen where, the extent to which continuing working from home, changing working practices, social practices, alter business models. And so there are, and then of course the whole sort of labour migration story, the access to the EU single market labour pool is not going to be there post-Brexit. So there are going to be some big moves in those sort of, if you like, those labour market tectonic plates. And it's hard to I think it's hard here and now to predict with confidence where, say, UK unemployment might be in 5 or 10 years' time, because ultimately a lot is going to depend on what trade deals the UK puts in place, the general economic policy, whether the UK continues to be a magnet for global investment, and so on. So these fundamental economic questions will really drive that medium-term view of the labour market. But what we can say is, I think, at least for the next year or two, that although we might not yet be through the worst, and there could still be a shaky period for the labour market at the back end of next year as the furlough scheme is wound down and closed, we at least start from a position that looks much more robust than was feared a year or so ago.
And you've mentioned a couple of times about some very sizable, potentially seismic changes to the structure of the UK economy and of course the labour market as well. Do we perceive these to be lasting changes, as in not irreversible, but just changing trends over time will mean that these changes last in terms of the structure of the labour market? And then the other question to follow on from that is, do you think that will be replicated in other economies? Again, looking at Europe as another example where we have seen lower rates of unemployment than perhaps we were anticipating.
Yes, I mean the big driver, I think, of the labour market over the last 2 decades has really been technological development more than trade or globalization, which have also been important factors. That there's no sense, I think, that pressure on employment is from technology is going to abate. So those challenges are going to be there. It may be that for certain sectors of the UK economy, reduced labour mobility vis-a-vis the EU does restore some, if you like, wage bargaining power. We see some pockets of wage pressure. But ultimately, to the extent that the central bank detects that wage inflation and views it as unjustified by productivity improvements, then you are going to get some monetary policy tightening. So I don't think we are going back to a world ultimately where we see wage inflation running at 5, 6, 7% a year, and inflation without some monetary policy action exceeding its target. So I think there are going to be some huge structural changes. It's very hard to forecast this, but again, on a sort of 1 to 2 year horizon, it doesn't feel like things are going to be very different. The early wage settlement annual pay deal data that we can see looks to be anchored around 2% a year, where it was for several years before the EU referendum, after the EU referendum. So some of those fundamentals, as I say, don't seem to have changed in the aftermath of Brexit. So for me, although there is some discussion post-Brexit about a more inflationary economy as a result of being a less open economy, on a sort of 1 to 2 year view, I don't see any dramatic change. But beyond that, it's we will see, and we'll see how open the UK chooses to be. I mean, when labour shortages emerge, whether the UK then adopts a more liberal migration labour market approach.
Yeah, I think we could probably do an entire webinar or podcast on trade deals and labour markets, but that's for another time. I'm going to turn back to you, Sam, because you mentioned something you said about GSS, and certainly in terms of what investors want, it seems at the moment that ESG is very popular. Is it that ESG is just basically going to become the norm over time, such that it's the benchmark for returns, and so that any spread differentials that there are at the moment will close?
Yeah, I mean, I think one, it's a focal point for issuers in terms of targeting their goals and becoming more efficient across the whole of GSS. I mean, I do think from a funding perspective, it is quite clear that you can fund at a more efficient rate through a GSS instrument, and therefore, that's you will see that as a natural catalyst for further issuance in that space. I think from the investor side, yes, we are continuing to see an increase in specific funds, sustainable funds. And as I say, you've seen issuers now, such as the Austrian utility Verbund, issue the first use of proceeds and sustainability-linked instrument, which garnered significant interest from investors. And you've also, as I said, I talked around Total, you're also seeing lots of other issuers do innovative instruments, both on the use of proceeds and sustainability link front. I think you will also continue to see the hybrid market, a format where issuers increase their amount of green funding, given what we've continued to see through COVID-19 is an increase of the use of hybrids from corporates to shore up their balance sheets. And I think going forward, a lot of the programs on the CapEx side will be funded in the hybrid market, and therefore that'll lead to increased green issuance. I still think a lot of investors will tell you that the ESG element is one of the key principles of any investment decision anyhow. So I think whether an instrument is green or not, ESG is overall one of the key pillars of an investment decision will need to be there. So I think it's just going to be, become part of the DNA of everyone. That I think whether a bond is wrapped or not, the issuers will need to be very much on point with their the ESG elements of any transaction. So yes, I do think if it wasn't already becoming part of the norm of financing, it will continue to be.
Yeah, I mean, I do think that given the demand that we're seeing out there now and the growth in this area, that it will just become a benchmark like many other things that we've seen in terms of the development of financial markets in the last 20-25 years since I've been working in the financial markets. I'm gonna throw in a real hand grenade question for the both of you now, which is, given everything that you've said, what blows this off course? What materially changes the outlook for markets and economies, and not just in terms of, we're perhaps conditioned to think of things in terms of market and economic weakness, but what about unexpected strength as well? What are the things, the driving factors that our listeners should be thinking about that could accelerate the process of issuance or change the dynamics on duration, and for Ross, what could bring about an accelerated process of monetary tightening? I don't know which one of you wants to answer first.
I don't think either of us wants to have a stab at this.
Yeah, I'm happy. I mean, I think going into this year from the credit side, we were very, very constructive on the direction of the market. I think you came out of a record 2020 fueled by the central bank interventions. From our side, we continue to expect that the central banks will be very constructive towards the market with their programs. I think if you do start to see any more on the euro side, given the program is still running there, if you do start to see any pullback from the ECB and a lack of support for transactions, then I think that's one thing the investor base will keep a keen eye on. And I think from something which potentially could derail credit markets is one thing is we always follow what fund inflows are doing. And you've seen constructive fund inflows so far this year to the tune of around 2 billion versus 7 billion last year. But if you do see, for example, a bit of you are seeing general rising rates and an inflation story, do you see more of a rotation out of credit into equities, and therefore the lack of significant fund inflows from the credit side? That's one thing which we would have a very keen eye on our side from a fund inflow perspective. But I think overarchingly, investors continue, given the fund inflows, to want to chase yield. So I think as long as the recovery story of COVID-19 continues to play through, investors will continue to want to own higher beta yielding assets, and therefore, unless you see a pullback from the fund inflows, it's hard to see what does derail it from here. To be frank,
Ross, over to you.
Ross.
Yeah, from my side, I think the main downside risk is an obvious one. It's that as the economy reopens and infection rates will inevitably come back a bit, we end up with variants of the COVID virus, which prove problematic and perhaps result in another lockdown, and that stop-start nature of this process just inflicts more damage, and you get to a sort of tipping point in terms of the economy where it just becomes more difficult to provide the degree of support that we've seen over, say, the past 12 months. Perhaps more optimistically, if things were to go much better than expected, I mean, what might trigger that? I think you can see in the size of the fiscal response. We're running in the advanced economies the largest deficit since the aftermath of the Second World War, which is extraordinary. We've really seen nothing like this during our lifetime. And if you look at the US, the incoming Biden administration is overlaying on an economy that seemed to be doing pretty well anyway. There wasn't really a lockdown in the US in the first quarter. You have a huge, near $2 trillion fiscal stimulus package. And this might just prove to be too much stimulus. And actually what we end up with is fueling not just a short-term period of inflation, but something that becomes a little bit more ingrained and harder to deal with. And of course, the cost of that would be a more aggressive monetary policy response, interest rates rising sooner and more sharply. And for economies that are still carrying vast amounts of debt, even the household sector, which hasn't taken on a huge amount of additional debt in recent years, still has a huge absolute amount of debt. And then the corporate sector, which has piled on debt over the past 12 months, partly just to for cash flow purposes, day-to-day operational purposes. So the big risk in all of this, and the thing that really pulls the rug from under the policy response, is if inflation resurfaces and proves to be a bit more intractable. Not our central case, but that would be, I think, the principal. That's where the principal macroeconomic risk lies over the next few years.
Gentlemen, thank you for your candor on joining us on this podcast, and look forward to the next installment. Thank you very much. I hope you've enjoyed this episode of On Point. Please do subscribe to our channel to get future episodes, and navigate to ci.natwest.com for the latest updates on what's moving markets. We also encourage you to follow us on social media to get all of our latest content. Speak to you again soon.